So here's the question from Stuart Kaiser over at Citi. Seatbelt sign on or off? 4 reasons for caution: bond volatility, wages, spending headwinds and a prolonged government shutdown. Contrast that with reasons for optimism, including orderly price action, muted stress metrics, positioning and macro data, plus the one wild card of an upcoming earnings season. Stuart, I'm pleased to say, joins us right now. So Stuart, put it all together. Is seatbelt sign on or off?
Hey, Jonathan, good morning. I might not be getting up to go to the bathroom just this week, but, we do think things are going to, hopefully improve over the next couple of weeks. It'll actually be nice to get economic data this week, to be completely honest with you. If we didn't have ISM and payrolls and then CPI next week, it would have been really hard to drive, kind of without that visibility.
Well, Stuart, one point you've made is this rally has been built on upside surprises. At least this year it has. Stuart, that data, walk us through it. We had Seema Shah of Principal on the programme in the last 30 minutes or so. Stuart, she made the point that she expects the weakness to arrive, but ultimately it will only arrive in early 2024. And we're about to see more resilience in the economic data between now and then. Is that something you anticipate as well?
Yeah, look, that is the big question. I would say, look, if we get data over the course of the next 3 months, excuse me, like we've had over the last 3 months, which is, a strong labor market, CPI maybe not as low as you would like it, but still sort of low volatility on a downward trend, then I think, yeah, that's going to be a net positive for equity markets, and we're going to continue to be able to move higher from here. Obviously, bond volatility has been the bogeyman recently, but I would generally agree. Our economists don't have a recession really in the forecast until early next year, so you wouldn't really expect that economic data to be slowing meaningfully, at least in the next couple of months.
I know Andrew Holdenhorst on the economics desk over at Citi. Stuart, you know him well. I know he's looking for that one extra hike in November, looking for a decent payrolls report this Friday as well. I think he was looking for something like 240,000. Stuart, with that in mind, can you walk us through what you think the current relationship is between rates and certain sectors in the equity market? Because what we've witnessed this year is tech's done pretty well, even with another down year for treasuries, and banks have struggled, even with rates pushing higher. Stuart, what is that relationship between sectors and rates?
Yeah, look, it's a great question. I mean, to your point, typically speaking, tech would not have dealt with these higher yields the way that they have. But, I think there was a few things going on in the background there. One is just that positioning and sentiment and valuation were so washed out in tech to begin the year that even the move higher in yields sort of didn't offset that. Plus you had, as you mentioned, very, very positive economic growth surprise going on in the background, really difficult regulatory environment for the banks, and, a deal calendar that's been probably not what people had hoped for. So, I think the rates relationship has kind of been overwhelmed by those kind of more fundamental and positioning drivers on a year-to-date basis. Going forward here, our view is, tech is the area that is the most exposed to this rates volatility, and you've seen that, right? I mean, the last month and 3 months have not been great for tech performance at all, and given that that's the narrow leadership of the market, it kind of creates a risk to the market overall.
Do you have a reason to believe then, Stuart, that traditional relationship between stocks and bonds can reassert itself, the more intuitive one, that a 60-40 starts to work again?
I mean, traditional, I think, is a little bit subjective. If you look at the relationship between bonds and equities, from the late 90s until COVID, higher nominal yields were positive for PE, right? And that was because you had inflation expectations so well anchored that when yields were rising, it was really a growth impulse that was driving them. I think ultimately, over the medium term, you would expect that relationship to reassert itself because, the Fed is so consumed with keeping market-based inflation expectations anchored. So I think if you're in an environment where inflation expectations are anchored, then equities can work in a rising yield environment as long as that move in yields is kind of well contained and driven by the right things. The last, call it 4 to 6 weeks, the move higher in yields has not been coming from a good place, right? and I think that's really what's been hurting tech so much.
Stuart, when you say that it's not been coming from a good place, can you identify more specifically what you mean by that?
Yeah, I think at the beginning of the year, yields were moving higher because growth was stronger than expected. Recession risk was being pushed out, and some of those rate cuts were being taken out of the system. So yields were moving higher really because growth was surprising to the upside. I think over the summer, you started to get more concerns with sticky inflation. BOJ kind of raising the top end of their range. Obviously, a lot of Treasury supply on the calendar into next year. And those were viewed as really not positive drivers of yield higher, actually kind of riskier drivers of move higher, of yields higher, and that's why equities have not responded to it as positively as they had from, let's say, January through June.